Capital Ideas, The Improbable Origins of Modern Wall Street, is a fascinating journey through the intellectual breakthroughs that have shaped the financial landscape, penned by financial historian Peter L. Bernstein. It explores the evolution of financial theories from academia to real world Wall Street practices, narrating how these revolutionary concepts have transformed the art of investing. Here's our pick of the top 10 insights from the book. 1. The value of an asset should be determined by the present value of its future income, not by speculation or past performance. Let's put the fun in funding and talk about the wisdom of Wall Street's wise owls. Picture this: your friend boasts about buying a shiny new stock based on its trendy ticker symbol or its mind blowing performance in a bygone era, like yesterday's killer disco track. You, on the other hand, channel your inner financial sage and whisper, "Hark! The true worth of this slice of corporate pie is baked in the sweet, sweet cash flows of tomorrow's promise, discounted back to today's dollars with the sorcery of math." The old school speculators might gawk, but you know that assessing an asset's value is like a clairvoyant peering into a crystal ball, except you swap the hocus pocus with cold, hard future income calculus. So next time you're at the investor's soiree and someone pops the what's hot question, you'll know it's the streams of future Benjamins that really turn up the heat. 2. The introduction of the Markowitz Portfolio Theory challenged the traditional investment strategies by emphasizing risk management and diversification. Markowitz, a man who looked at a scatter of stocks and saw a ballet of numbers twirling in a diversified dance. Before Markowitz waltzed in with his portfolio theory, investors were like single flavor ice cream enthusiasts, simple and sweet, but oh, so vanilla. Markowitz taught them to swirl different scoops together, crafting a delightfully complex portfolio sundae that balanced the taste of gains with sprinkles of risk management. By mixing and matching assets like a DJ blends beats, the investing world was shaken, not stirred, into understanding that a solid investment portfolio is like a good party mixtape. It's all about the variety. 3. The capital asset pricing model, CAPM, despite its later criticism, was revolutionary in calculating the expected return on investment by factoring in risk-free rates and market premiums. The Capetious CAPM. Before this brainchild of finance whizzes hit the scene, investing was like a game of pin the tail on the donkey, blindfolded with a few spins. Suddenly, here comes CAPM, strutting down Wall Street, turning heads with its snazzy formula involving risk-free rates and market premiums. It was like someone handed investors a financial GPS, saying, "Here, navigate the markets with a bit less guesswork." Sure, later on, critics would take jabs at CPM for being as idealistic as a unicorn in a business suit. Yet, it forever changed the investment game by introducing a systematic way to measure the balance between risk and reward, all with that irresistible charm of mathematical elegance. 4. The efficient market hypothesis, EMH, suggests that it's nearly impossible to beat the market consistently because prices reflect all available information. Imagine playing whack-a-mole blindfolded. That's like trying to outsmart the market if you buy into the efficient market hypothesis, EMH. It posits that stocks are about as predictable as a teenager's mood. Every nugget of news, rumor, or CEO sneeze is instantly baked into the stock prices like blueberries in a muffin. So if you think you've got a hot tip, guess again. The market's already snacked on it. EMH is Wall Street's way of saying, "Good luck, champ," to every overconfident trader who thinks they've got the cheat code to infinite riches. It turns out the house always wins. And in this game, the house is a sprawling casino with Wi-Fi as fast as the speed of light and more gossip than a high school prom. 5. Contrary to popular belief, the random walk theory implies that stock price movements are unpredictable and do not follow a discernible pattern. The random walk theory. It's like Forrest Gump's box of chocolates for the stock market. You never know what you're going to get. It sachets into Wall Street's highfalutin soiree and tips over the punch bowl of predictability. This insight is a cheeky wink to investors trying to read the financial tea leaves. They might as well be trying to predict next week's weather with a horoscope. Every tick and talk in stock prices is more of a mysterious fluke than a Morse code revealing hidden secrets. Essentially, if you're looking to the patterns of the past to forecast the future in the stock game, you're likely engaging in financial astrology. Fortune tellers and chart enthusiasts may not appreciate the humor, but your wallet will thank you for embracing the randomness. 6. Behavioral finance emerged to explain why and how markets might be inefficient, accounting for the irrationality of investors. Immerse yourself in the perplexing world of behavioral finance, where the cold logic of numbers meets the hot mess of human emotion. It turns out that markets, much like that one relative at family gatherings, don't always behave rationally. Contrary to the cool, calculating investor envisioned by classical models, the average Joe and Jane on Wall Street often make financial decisions with the finesse of a toddler choosing candy. Whether it's following the herd off a cliff or holding losing stocks with the stubbornness of a mule, the irrational quirks of investors create a financial circus that traditional theories couldn't juggle. Hence, behavioral finance waltzed in, shining a spotlight on our cognitive biases and emotional roller coasters, ultimately reminding us that in the grand casino of Wall Street, the house and human nature always win. Seven, the Black-Scholes-Merton option pricing model provided a groundbreaking framework for valuing options, which led to the explosive growth of derivatives markets. The Black-Scholes-Merton option pricing model, an algorithmic Rosetta Stone of the finance world, the E equals MC squared of Wall Street. This beauty turned the esoteric art of options pricing into a science. Picture traders before the model, like bakers without a recipe, tossing in a pinch of this, a handful of that, hoping their financial souffle wouldn't collapse. Then came Black, Scholes, and Merton, wielding their financial calculus like Excalibur, slicing through the Gordian knot of risk, time, and money. Post-BSM, traders could price options with the mechanical tranquility of a Swiss watch, sending derivatives markets into a joyous frenzy, akin to kids in a candy store, with much higher stakes. Eight, bond pricing models were revolutionary in adding to the understanding of interest rate risks and the pricing of debt instruments. Imagine you're in a bond pricing bakery where every cupcake is a debt instrument. You've got vanilla government bonds, chocolate corporate bonds, and the wildberry high yield bonds. Each has a price tag, but here's where the revolutionary input of bond pricing models saves the day. These models act like a super smart baker who can sniff out the sugar to flour ratio, interest rate risk, and sprinkle fairy dust, math, to calculate how much each sweet, or rather each bond, should cost. Before this, we were all winging it, trying to figure out if Granny's savings bonds were the deal of the century or a financial toothache waiting to happen. These models turned financial bakers into bond pricing pastry chefs, whipping up market delicacies with precision because who likes overpaying for a cupcake, even if it's frosted with the lure of safety or high returns? Not your wallet, that's for sure. 9. The arbitrage pricing theory provides an alternative to CAPM by considering multiple factors that could affect the return of an asset. The delectable arbitrage pricing theory, APT, simmering in the financial kitchen as the spicier cousin to the somewhat bland CAPM stew. This exquisite insight from capital ideas unravels the magic behind APT's approach, which, rather than putting all its investment eggs in one basket with the market factor, as CAPM does, this theory whisks together a flavorful mix of multiple risk factors: interest rates, oil prices, who won the World Series, you name it, to better season the expected return on assets. It's like predicting the weather in multiple locations to plan your portfolio's picnic rather than just staring at the clouds above Wall Street and hoping for the best. Bon appetit, investors. 10. Despite the quantitative nature of modern finance theory, real world frictions like transaction costs, taxes, and human behavior often lead to significant deviations from theoretical predictions. The pesky reality, where the frictionless world of pristine financial models hits the bumpy road of actual markets. In Capital Ideas, we learn that beneath the gleaming surface of equations and efficient frontiers lurk the inconvenient speed bumps of transaction costs, the relentless bite of taxes, and the most unpredictable of beasts, human behavior. Fancy algorithms can't fully digest the fact that Uncle Sam wants his cut, or that traders throw tantrums like toddlers when markets tank. So, while modern finance theory sits pretty in academic journals, real world investors hit the trading floor with the messy task of wrestling these unruly real world gremlins. To sum it up, Capital Ideas explores the evolution of financial theories that transformed Wall Street, from the fundamental valuation of assets and the innovative models for managing investment risk to the recognition of market inefficiencies driven by human psychology. Thanks for watching and embracing the journey through the financial landmarks that have shaped modern investment strategies.